All right, so let's get into the energy stocks. Energy stocks are the ones that's going to be very difficult to trade, especially on the intraday level. I have personally experienced some difficulties in energy stocks. I took countless losses on, especially if it's energy related. Most of them that starts with a mid cap, so anywhere between 200 million to 500 million as an initial cap. Sometimes even with the small caps, they always tends to hold much longer, and they're more stubborn, especially when there is a consolidation breakdown, and it will never break down fully. So what it ends up to be is they will set up with a really high neutralized area, then will slow grind, and it's going to be a nightmare for shorting. Whenever you want to trade energy stocks, always focus on the intraday level and try to not build a swing position, and swing shorting on energy stocks is not going to be very effective at all. So stay away from this sector as long as possible. And also from my observations on statistics, that it takes much longer to drop compared to biotechs. And you already know that how hard biotechs tends to fade from the top. So what I found out is most of the tickers that with intraday run up, there's about 50% chance that the biotech always comes back, and it will take a couple months before they fade to the original level where they started to spike. Then for energy stocks, it takes even longer compared to biotechs. Do not build a swing positions on energy stocks, and they are a big red flags for you to trade. So there's some exceptions. If the chart has a fresh individual resistance, let's say a pretty heavy individual resistance, yes, it is okay, and it's much better to trade with that resistance. But I would not recommend sizing in multiple parts. I would say size in one go. Only do one entry, one exit, so it's much cleaner, especially on your thought process and building on multiple entry. I don't think it's very ideal, especially trading on biotechs and energy stocks together. All right, so there's another type of trades that you want to know about is IPOs. Basically, IPO, initial public offering. Now, pretty simple that they never traded before, and once they announce their IPOs, the stock starts to spike pretty much with no resistance, no support, just blank charts. So there's a couple problems with IPOs. First of all, is that majority of the time that you cannot find the accurate flow and market cap. Now, typically I use Yahoo Finance and Finviz to check out the float and market cap. And what I found out is there's about 50% of the time that their float and market cap are not accurate. Sometimes you only get a float, sometimes you only get a market cap. I would say you want to try your hardest to find both. And another thing about IPO is don't trade on the first green day, because whenever it doesn't really matter the float and the market cap of the IPOs, the candles can be as aggressive as a nano floats, it can be as passive as a bigger float. You don't really know how the IPO is going to really play out. I've tracked decent amount of statistics on IPOs. They don't follow the average spiking percentage in a high market cap or high flow, or lower market cap or low flow. They don't follow any type of average spiking percentage. So I would suggest that you want to avoid the first green day on IPOs as much as possible. And IPO on the second day is always tradable if they does a large percentage gain. Now, I have traded decent amount of IPOs. If they gain over 1,000% in the last 2, 3 days, then it's tradable. But if only gains about 20, 50%, then it's not really tradable. So on the second day, to judge if it's tradable or not, make sure to check out the gaining percentages. I would say above 500%, then it's okay to trade. And you see a lot of IPOs actually go up that high because, as I said, their average spiking percentages does not follow the average chart that does have a historical trading history. So the float and market cap ratio, right here is a typo. It does not apply on IPOs, but it does apply on the downside. So when the IPO starts to going up, and sometimes it can go up as a nano float. So on the going upside, doesn't really follow average spiking percentage based on a certain market cap and flow zone, but it does apply on the downside. So if it gains over 1,000%, 500% on the upside, and once the stock start to lose its momentum, you will lose about 50%, sometimes even 100% from the top. So IPO are the ones that drop the most compared to any other patterns. But one thing up to note is IPO sometimes do trade with a really low liquidity, only with 1 million or 500K float, 500K volume, sometimes on a 300 million market cap and decent amount of float. So the flow and market cap and volume doesn't really make sense as long as you can see a consolidation, a decent dollar block, and apply that to the downside, get a decent entry, have a decent risk, sizing according to the volume, then you should be good to go. I think IPO, you can, from my experience, that IPO can swing for at least 3 to 4 days to get at least 75% to 50% of reward from the top. All right, so this is the chart of WNW. This is the one I traded, and you can see that it went from $10 to 160. And you can see the overall gaining percentage is about 1000%. And this is the chart you want to be looking at. First of all, that you want to see aggressive spikes and some consolidations. And first of all, you want to see the support is going to be as far away as possible from you. And you can see the first support you see is right here, which is around $40 consolidation. You can see that as a support. This one slow grind from 16 to 60. Then second day went to 140. Once it forms its consolidation, you can see the volume is dropping compared to the yesterday. You can use the volume ratio and compare with the yesterday's resistance, and you fade it 1, 2, 3 days from the top. So this is the classic standard chart to short into an IPO, and the float and market cap, it actually follows the standard, which is flows between 3 to 20 million, and market cap is between 0 to 200 million. And if the IPO doesn't spike as far compared to WNW, only spikes 50%, do not touch it at all. But with consolidations and also with the support is really far away, shorting on the downside, it's really rewarding. And always focus on the consolidations to see what's the dollar block on the consolidations. And the second criteria you'll be looking at will be the support level you want to cover right before the support, so which is around before the $40 area. So pretty easy chart, and I would say once you see IPOs, if you don't see this type of chart, it's probably not tradable. So now this is another IPO. This one went from 10 to 60. So the overall gaining percentage is not that big, only up about 600%. The support area I can see is around the $25, $27 area. And the stock went from 27 to 60 and came back all the way down to 28. So right above this support area, you can see this is the support, a little bit above that. This is a little bit different than WNW because the support area is a little bit close to it's a little bit close to the top. So you cannot fade 75% in 3 days. And you can see there's a bounce above that 27, 28 right here from that support. It went all the way back up to the 40, $47 area and came back down again. So this is the difference between the WNW, which is the previous one. Right here, the support is really far away. You can fade a long time and it drops 30% per day. Right here, the support is a little bit too close to the top, so it can only fade about 50%, then bounce back again from the support, then fade again. So if the support is far away, don't take your profits. If the support is close, take your profits along the way, then you can play ping pong on this one. So you can cover, short again, and cover. As long as you have a decent risk, I think this should be a pretty easy one to play with.